Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Jay Reaves, CEO of Reaves Asset Management. We're talking about utilities today, and utilities stocks have suddenly become the new AI play. The sector has surged more than 18% over the past 3 months and is now the best performing of all S&P 500 sectors year to date. Jay is also co-portfolio manager of the Reaves Utility Income Fund and the Virtus Reaves Utilities ETF, which has significantly outperformed the broader market cap weighted utilities ETF. So we'll talk about utilities and the ETF. Jay, welcome. Thanks for joining us today.
Thanks for having me on.
So today, as we are recording this interview for the purpose of reference, it's Thursday, May 23rd. And the biggest story of the market today is NVIDIA. NVIDIA stocks are surging after a blockbuster report, and their results signal that the AI boom is here to stay for some time. And this AI boom has driven a surge in demand for data center capacity in order to handle those AI workloads. And we know that data centers are big energy consumers, and AI applications, they consume even more energy than traditional computing. So let's start with that. Please tell us how AI has become a major driver of electricity demand in the US.
Yeah, it's actually really come on, just in the last few quarters here, where projections for power demand for AI-related data centers have just really skyrocketed. And it all comes down to a couple things. One, the H100 NVIDIA GPUs, each chip uses about 6 or 7 times the amount of power that the chips that powered cloud computing, kind of the first wave of data center build-outs use. So on a one-for-one basis, you're already talking about exponential growth in power demand. Of course, as use cases for AI build out, there's huge interest in just building more data centers, right? And I think I've seen a recent McKinsey report that talked about $50 billion of data center construction in the next few years. So the combination kind of adds up to a need, basically a tripling of power consumption for data centers from where we are today through 2030. And so just in terms of what that means is we as the United States probably need to build 50 gigawatts of new power to support that. To put that in perspective, the total kind of excess capacity that the United States has is about 200 gigawatts. So it basically eats into a quarter of the country's excess supply. It's always a good idea to have a lot of excess supply in case a plant goes down or you have significantly warmer or colder weather. So we're going to have to build a lot of that power, and it's not going to be easy. Southern Company just finished the 2 units of the Vogtle nuclear power plant. It's the single biggest power station in the U.S. It's 2.5 gigawatts, so roughly 1/20th or less of the power we actually need by 2030. And it cost Southern over $30 billion and took 17 years. So it's the challenge of bringing all this power online is just going to be huge. There's just gigantic amounts of infrastructure capital that has to be spent. Huge potential for power prices if this power doesn't come online. It's really, this potential just growth in power demand, really hasn't happened in the electric sector. Effectively, the United States used less electricity in 2021 than it did in 2007. So there's been no growth for a long time. And all of a sudden, we're going to grow 5, 6, 7% per year for a decade. So it's truly remarkable, unique times.
It is remarkable for sure. So do you think we will have enough power for these data centers or should we expect electricity shortages going forward? I also read that while there's a lot of power in the United States, it's not efficiently transmitted or efficiently distributed. So electric transmission grid is not ready for this demand. So I was interested in your thoughts.
So I think we will have enough power. It's the companies, the hyperscalers that are building out the data centers are the biggest, strongest, most well-capitalized companies, basically in the history of the world. And if a utility doesn't provide the power, it is certainly within the realm possibility that Microsoft or Amazon will be able to just build their own power plant right on site and directly feed the data center itself. So I'm not worried about that per se. I think that the bigger thing is at what price, right? Because like you said, there is a lot of power supply in the United States, but for a lot of it, the price of power needs to be a lot higher for those plants to be economic, right? So I think it's kind of about these big hyperscalers, really just finding a good mix of kind of new power where they can, sign a contract to incentivize, I guess, new power generation to be built. But at the same time, you did mention the transmission congestion, and that's a very real thing. And I think a lot of data centers are going around the country. They're talking to every utility right now, and they're basically willing to site wherever a big, large data center can be sited. Pennsylvania is one such example where they're getting a lot of requests for new construction there, and it's because they have a little bit of excess transmission capacity. So that's it. Like you said, it's not just the power generation, it's the infrastructure surrounding it as well.
So you talked about the hyperscalers. So these companies, Microsoft, Meta Platforms, Google, and Amazon, they are spending tens of billions of dollars on these data centers. And most of them have pledged to use renewable energy to power their data centers. And that is driven by their sustainability goals. So this has, in general, led to higher interest in alternative energy producers. So do you think clean energy will play a big role in powering all these data centers going forward?
The answer is sort of. I'll explain that in a second. I think nuclear, I believe, has become by far the preferred solution. One transaction that I think really highlights this was Amazon Web Services signed a deal with the Susquehanna nuclear power plant to effectively site a data center right next door to the plant and take half the power, at some price that is private, but likely well above whatever the current market price was. Nuclear hits, at least Amazon's sustainability targets. Obviously, no emissions, and it's 100% reliable. The reliability issue is going to be interesting because I guess my understanding of these learning models is that if you ever lose power in these power plants, the AI's knowledge actually decreases. Like you have to relearn what you've lost when the power goes out. There's no memory, if you will. So reliability is of utmost importance. I think what the plan is for those companies with the sustainability targets, generally so far is to sign some kind of a deal for a thermal power plant, probably natural gas, give or take, to cover the critical generation needs of the data center, but then to also contract out for building the equivalent amount of new solar or new wind. And what those companies will do is take that power produced by the renewable energy and then sell that power to the market and then buy back power from the grid. The grid effectively creating 100% reliability for the data center. It'll be interesting over time if that truly satisfies some companies' sustainability targets, because you're really just shifting it, and you're buying renewable energy credits somewhere else that's not necessarily powering that distinct data center. But for now, it's kind of a combination of both. We're going to build a huge amount of renewable energy and probably utilize a similar amount of natural gas fired power until some kind of a technology change comes in where hydrogen or something like that becomes more feasible.
Yeah, right. It's going to be very interesting because it seems that renewables are not ready as of now. Wind and solar, they are not 24/7, 365 days a year. And nuclear energy is going to be a really interesting part of the equation because it is the cleanest form to produce energy, and it currently accounts for just about 10% of the global electricity generation and about 20% in the US. So we could see an expansion of the nuclear energy in the coming years. But it is going to take a lot of time.
Yes.
So I guess for the time being, for utilities, the solution is to just meet the rising demand by using coal-powered and natural gas-powered plants, and then balance that with expansion of renewables going forward.
I think that's mostly right. I think coal usage is likely going to continue to decline, and with current EPA rules, they effectively have to be phased out, and that can change, of course, with election outcomes and whatnot. But coal probably keeps declining. But gas usage, there's a good chance that continues to increase, especially over the near term.
So now let's talk about the investment case for utilities beyond artificial intelligence. So the sector was earlier known mainly for its defensive nature and steady dividends. Last year, these companies suffered from rising rates and, in general, investors' preference for high growth areas. But if I look at the performance over the past 5 years also, the sector has significantly underperformed the S&P 500 index. So could you please talk about the investment case for utilities and some reasons for earlier underperformance of the sector?
Well, today, I think when you look at the sector, if I start with one of your last parts of your question there, that over the last 5 years, even including the rally, so through today, right, the utility index, the S&P 500 utilities are up about 7% a year. The S&P 500 is up little more than 15% a year. Obviously, it's been a big rally. But what's interesting is that on an earnings growth basis, utilities have grown about the same as the S&P. So earnings growth for the utility index is about a little more than 8%. So if you think about it that way, valuations actually declined a little bit over the last 5 years, just because earnings growth has been greater than stock price appreciation. So today, there's a lot of companies that are trading in the kind of 14, 15, 16 times earnings on a forward basis. That not only is cheap relative to most utilities history, it's basically historically cheap relative to the S&P 500. Now, the S&P 500 has changed and it's driven by NVIDIA and Microsoft, and it's not the S&P 500 of 20 years ago. But that's kind of true for utilities too. Most utilities have been able to increase their growth rates a little bit, but in utility worlds, a little bit is a lot. So most utilities are able to grow their earnings 6 or 7% a year. And if you add in a 3 or 4% dividend, you can make your way to a kind of 10%, maybe low double-digit type return. The 15, 16 times earnings, even if you ignore low interest rates of the last several years, when valuations did in the utility sector get ahead of themselves, valuations are back to the lows that they were back in 2013, 2014. So even after the run, valuations are not that demanding, really. The upside is that all these companies, and it is from AI, but all these companies are growing a little bit more. So the amount of capital they get to put to work should lead to earnings growth. Utilities get a regulated return, but it's a return on the amount of invested capital they have. So as the infrastructure demands, whether it's generation or transmission or distribution assets, as those investment needs increase, the earnings potential of these companies can increase. So the basic case is, low to average to below average multiples with slightly increasing overall growth rates. And they're utilities, right? They are defensive. You can be very confident in earnings and earnings growth. And you can reasonably look out and fully expect these companies to grow earnings every year for the next 5 or 10 years. So it certainly is still a defensive sector. It's just a little bit more growth in the next 5 years than what we experienced over the last 5.
Excellent. Now let's talk about your ETF, the Virtus Reaves Utilities ETF. The ticker symbol is UTES, UTES. And I noticed the performance. It's up about 23% over the past 3 months. Very impressive. Please tell us about the CTF and your investment approach.
Yes. So if I come back for a little bit, just Reaves Asset Management, we were actually founded in the early 1960s and have always concentrated on utilities. Even today, for our institutional accounts, utilities make up 60% of the holdings of those portfolios. So that's we invest in energy companies and communications companies as well, but we've always been focused on utilities. So when we launched this ETF, the thought process was it's a complicated sector. All these companies are regulated at the state level, so they all have individual quirks and legal ramifications that, a New Jersey utility is completely different from a California utility. But because it's small, it's only 2 to 3% of the S&P 500. They all kind of get lumped in together, and they trade based on whether people need to get defensive or offensive, or if you think interest rates are rising or falling. And the individual fundamentals of these utilities, largely get ignored, or they get kind of washed out or offset by, just all these other bigger top-down factors going on. So we've always aimed to run a concentrated portfolio of our best ideas. What we've done well over the last 3 months, but really over the last year, is we've had a pretty concentrated bet on utility, on the most power exposed utilities. And it is, AI, but there's a lot of demand growth outside of AI as well. There's reshoring of manufacturing, industrial growth, even electric vehicle growth. So there's other sources of electric demand growth beyond just AI. And our thought process was companies with exposure either to building generation or just power prices could do pretty well. So our biggest bets are in our biggest holding is NextEra Energy, which is kind of two things. Half of it is a utility in Florida, which is probably the best run utility in America. But the other half is leading renewable energy developer. And as we were talking earlier, a lot of potential for renewable energy. Our next two biggest holdings are Vistra and Constellation, which are power producers. But Constellation really, and Vistra because of an acquisition, but in the Inflation Reduction Act, there was a tax credit for nuclear producers. The problem with nuclear was, power prices had generally gotten cheap, especially as we brought more and more renewable energy on. Power prices, can go negative at times during the day, especially in Texas and California. So what the Inflation Reduction Act did was effectively guarantee profitability of nuclear power plants. Without it stopped the closing of nuclear power plants. We had closed a significant amount of them over the last decade or so. They were very volatile, commodity price driven stocks with not very attractive multiples that kind of overnight, because of the law, became more like a long-term contracted infrastructure asset. So that was the original thesis on the power side. And obviously it's evolved now to a real power demand growth opportunity as well. So that's the idea. We spent our careers studying these companies and take pretty concentrated bets, and hopefully it works out as well as it has over the last year.
Right. So I am looking at the top three holdings that you mentioned, and these account for almost 40% of the portfolio. So you talked about the concentrated bet, and that seems to be paying off as of now. And for performance of these stocks, I noticed that Vistra and Constellation, they are up more than 149% and 92% respectively. Very impressive. NextEra is up about 26% year to date. So what about the valuations now, since these stocks have gone up so much so soon?
Yeah, so it's anytime you're talking about stocks that are up close to 100% in the utility sector, it's an odd feeling. It doesn't happen that much, but I think Vistra and Constellation are somewhat unique, because I think if you have a view that power prices are going to rise over the next few years as all these data centers come on, then both Vistra and Constellation can look very cheap. They're really a way to express your views on, power markets, how likely the data center, AI data center build out is to happen, or if it's going to get slowed down. Obviously, we have big positions in these stocks, so we're bullish on power prices and the build out of AI. So that's we think those companies should be able to grow free cash flow fairly significantly. They both have buyback programs. So certainly if there's a supportive power price, those stocks can be, are still cheap even after the run. NextEra, of course, has that renewable building division. But in general, this was a company that traded at close to 30 times earnings in the height of the ESG renewable phase, kind of early 2021. Also very low interest rates. Today, it trades at about 20 times earnings. And I'm hesitant to do a direct comparison because it's a different environment today. I think if you assign kind of reasonable valuations on the value of this renewable development team, and then a nice premium on the Florida utility, which again is really one of the best in the country, there should be plenty of upside in NextEra. The rest of the portfolio are kind of the traditional utilities, and goes back to what I was saying before, that they all kind of trade at 15, 16 times earnings, which is kind of about average to below average in the zero interest rate days of the last few years. And so, none of those valuations are that demanding, and still feel pretty positive about the group. That even after the run, it sounds weird to say that, but I think it's important to think about the context that 2023 was one of the worst years ever for the sector. I think the S&P utility sector underperformed the S&P 500 by 33%. And I believe that was the single worst year ever on a relative basis for the sector. So while things have run here, it's really just a little bit of the start of the comeback against a backdrop of prior very poor performance.
Very interesting. We'll have to leave it there, Jay, but thank you so much for joining us, and also congratulations on the excellent performance.
Thank you.
That was Jay Reaves of Reaves Asset Management. Now let's recap the ETF tickers. So the ETF which is actively managed by him is UTES, UTES. It is the Virtus Reaves Utilities ETF. This has about 98 million in assets and has an expense ratio of 49 basis points. The most popular product in this space is by Spider State Street. It is the utilities sector Spider ETF XLU. XLU is cheaper, charges 9 basis points, and has about 13.4 billion in assets. But UTES has significantly outperformed XLU, as I mentioned, and other market cap weighted ETFs as well. For example, Vanguard also offers an ETF. The ticker symbol there is VPU. VPU has about 5.7 billion in assets and an expense ratio of 10 basis points. With XLU and VPU, you get kind of similar kind of exposure. Both track market cap weighted indexes. UTES is actively managed, as I mentioned earlier, and has done quite well. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.